Hi, this is Randy Finney with Right Side of the Chart, and this is an early session or probably more of a mid-session update now for Monday, July 27th, 2026. It's 12:19 p.m. Eastern Time. So I'm starting the video. Here's what we're going to go through. We're going to take a brief look at the markets via the major indexes that I'm watching. That is QQQ and SOXX, the semis, also the financials, XLF, and then that all relates to the VIX, as I've been stating for months now. The VIX is certainly setting up bullish, poised for a potential big rip, but it's conditional, as I've been stating, on the financials breaking down, because the VIX is based on put and call buying on the S&P 500. So the NASDAQ can go to hell in a handbasket and back, and it doesn't matter because there are no financials in there. The S&P 500, it's the second largest sector, and that's what's kind of been buoying the market. Again, and I'll speak a little to that whole sector rotation thing. So here's what we're going to do in this order. We're going to look at the equity markets, QQQ, SOXX, the financials, and the VIX. We'll do that. I'll talk a little bit about individual stock ideas. Won't be an all-inclusive video. I'm going to touch on the consumer staples, particularly the defensive issue stocks. I still like a lot of those being in the packaged food sector. The grains as well. We'll get to those. And I'll touch on Treasury bonds, something very, very important. I'm very much watching this week, especially with the Fed on deck. And then at the end of the video, strategy, and I'll comment on the put to call ratio, because I did notice one subscriber comment in here mentioning about the CPCE, which I watch closely, the equity only. So I'll speak to that a little bit. I think it's a good time to bring that up. So thanks for mentioning that. Okay, let's dive into the charts. You guys have the recap I got out to you on Friday. Remember, I made a reply to somebody. I don't know if it was a joke or what. Came out at 6 o'clock. It's a weekly recap. You're going to get those at best Friday after the market closes, because it has to come after the last post. Last post I made of the day was at 5:30 on a video. And so then I have to wait for that to populate to get that information from the video into the weekly recap. And that just depends if I feel like working late on a Friday. Usually I'm going to cut out shortly after the market closes. So you may get those recaps in your inbox over the weekend, Sunday night. On rare occasions, if I'm gone over the weekend doing something, I'll get them out to you Monday morning. And again, it's just a summary of everything. But of course, you can go into any of the posts now, and you're getting AI summaries in the videos. So it's all there. It's again, this is just kind of giving you a condensed version. Sometimes I'll put the what to watch for next week, and if I don't, I'll do what I did today. I'll get it out to you like I did here. Things to watch for. And again, the things I want to highlight here is I talk about every time we have a potentially market moving Fed meeting. What I mean by that, not all Fed meetings are market moving. Some of them, there's a near 0% chance of a rate hike or cut. This time, there's a lot of mixed signals going around. We have a new Fed chairman, so anything goes, and the odds are not clear any one way or other. So this is a potentially market moving, and that cuts both ways. Market could go up, could go down. Then you also add to that, you have 4 of the Mag 8 stocks, so half of pretty much the stocks that move the entire stock market are reporting this week. So I cannot overemphasize the importance of that. And if there's going to be a catalyst to break this market out, I'll get into the charts in a second, out of this trading range we've been in now for 3 months, it's going to be this week between the Fed meeting and those big 4. It seems whatever happens in the Middle East now is just brief and fleeting, and the markets are shrugging it off, whether the straits open, closed, whether we have a deal with Iran or not. The market's already kind of learned to ignore pretty much everything Trump says, because, and again, if you listen to Marco Rubio, you have 2 factions in the, or actually it's Vance said it recently, that you have 2 factions over there. You have the rational Iranians that they believe they're dealing with, that say one thing, and then you have the hardcore religious fanatics that may not agree with that deal. And you have the You have the Houthi rebels that are, doing, additional attacks. So again, let's tune out the noise. The Middle East, unless nukes start flying, I think that's just something the market's kind of gotten used to now, including the price of oil up and down. But remember, and last night was a great example. Crude futures sunk on the latest deal, and so the stock futures rallied. All of that and then some was completely wiped out when the starter stepped onto the field. As I often tell you, don't take what happens in the after hour session with a grain of salt. You got the rookies on the field, a lot of retail traders, more and more people trading futures, and so on Sunday evening the futures are trading. But come the opening bell at 9:30, that's when the big boys step onto the field. I'm talking about institutions that have massive portfolios. Think pension funds, public and private pension funds. Think big hedge funds, mutual funds, and so that's when they have the liquidity they need. So again, take those overnight moves with a grain of salt. And that last night was a great example of that. We'll get to that in a second. So finally, just to reiterate, as I said here, a breakdown below those key support levels, we're going to get to them in a second, in SOXX and QQQ, they could hold. So I'm just saying take them with a grain of salt. If we break down this week, remember, you're going to have a series. It's not a singular event where the Fed makes their rate decision. That's a multi-phase process. There's the initial decision released at 2 p.m. on Wednesday. Then the dog and pony show comes out. It starts at 2:30 p.m. Eastern time, runs for 30 minutes or so. I'm talking about the press conference. And so I've seen, the market go one way on the initial Fed announcement, whether they cut, hold, raise, whatever. And then it goes the other way based on what the Fed chairman says. So you have that. Then you also have two different nights of earnings this week, Wednesday and Thursday, with the big companies. So really, you're not going to kind of have, or I'm sorry, I should say we should have a pretty good idea by Friday, especially well into trading on Friday, because remember, Apple and Amazon, the A's report on Thursday, I think it is, and the M's report on Wednesday, Microsoft and Meta, Apple and Amazon on Thursday. And so and the report after the close. So I'm just trying to preach some patience here. And again, a breakdown could very well stick. I'm just, again, I don't want to beat a dead horse here, but you're going to have that if the breakdown happens before any of those guys report or before the Fed meeting, it could go the other way after, depending on what the Fed does and depending on what Microsoft, Meta, Apple, Amazon, all collectively say. All right, so the notes are all in there, what to watch and what could move the markets this week. And for those of you who are risk adverse or just, have been getting whipped around in this market lately, because remember, I'm going to get to the charts in a second. We're in a sideways trading range. If you are frustrated with your trading, especially if you're only trading the indexes, then recognize it for what it is. You're in the middle of a trading range. The market's going nowhere. So let's dive into that. Let's get into the charts. You guys can read this summary. You know what to look for. Without further ado, QQQ. All right, QQQ. It remains an active short trade. That was the break of the March 30th uptrend line, primary uptrend line. Quickly hit the top of my first target zone. When you zoom in real tight, a target zone is just that. It's when I have two support levels in close proximity. I've covered this a lot lately, and that target zone was set at this gap. That's the early May gap right there, is where that target zone was. So we hit the target zone. We closed on the bottom of it Thursday. We punched down. I may have actually misspoke right now. When I eyeballed it this morning, I might have stated that as this level here as the bottom of the target zone. It's certainly a support I added. Let me check something real quick. Okay, yeah, that then was a typo. I noticed this on my chart, and I was just eyeballing this morning. That's where we hit. I had that all along as minor support. This was the last one I posted on July 17th, but you can go back as far as you want on these. I just randomly went back another, several weeks, and you can see I've had that level there with the reaction 676.92. So that may have been what I included in the today's summary. And if I did and stated that as the bottom of the T1 zone, I should have clarified that that is the next support level. And we hit it. So we undercut those lows. The divergence is still in place. This is the big thing, guys. So this is why it's not an well, other than what I just mentioned, the biggest four of the biggest companies in the world and the ones that matter the most, but was because we know it's very well documented for the first time in history. The GDP, there's just one sector, a very concentrated sector of the economy that has had an outsized contribution to GDP and earnings in the stock market. And again, it's not just the Mag 8, it's also that circle jerk trade between AI, money coming from them, from CapEx spending, and including the ones that are not publicly traded yet, like OpenAI, and the spending that they have. NVIDIA just announced another deal to guarantee, I don't know, I'm going from memory, I read it over the weekend, I think another like $250 million or 250 billion. It was some crazy number for for data center investments. And it's that same circular trade that's been going on for a long time. So that's what the market's going to be listening for. If they get a hint that any or all or most of those three big tech companies or four big tech companies are going to start paring back on CapEx spending, that could have a severe ripple effect. But again, guys, we go off the charts. The fundamentals do matter. And again, the takeaway is expect volatility this week. And again, as I said, a breakdown of these lows today that were tested, that was the next support level. Again, going all the way back, as far as you want to check the 60-minute charts, you can see reaction was expected off that level there. And that's what that was. So that's the level that needs to go now. We keep inching our way down, but we still have the positive divergence. And from my experience, there are exceptions to this rule, but typically with such a huge amount of potential market moving events coming up, but this week, particularly on Wednesday through Wednesday midday, late afternoon with the Fed, then the two earnings reports from the M's, and then the two earnings reports from the A's on Thursday. The market will typically go into a holding pattern. And again, it's not to say a breakdown can't stick or won't stick. It's just that you have a higher chance that it could prove to be a whipsaw. And so that's it. So come Friday, you will, all along the way, you'll know my thoughts. And hopefully we'll have some good direction on Friday. Now, let me tell you what I think is going to happen. If I'm right and we're going to hit my target, you know me, I love this going long on positive divergences, 60-minute charts. In a bull market, these are almost always the catalyst for new highs after a correction. So that is very, very much on the table. I'm not here to tell you that that's a possibility. I'd be a fool to tell you it's not. So, and technically the setup is there. So if the market likes whatever Warsh or the Mag Big Four are selling, then this is where we may go, and we may break out of this. This is the 3-month trading range right here. So if there's going to be a catalyst, it'll probably be this week. This is still the way I think it's going to go. You can say what you want about where you think the market's going to go. That is subjective. That's an opinion. Fact is, right now, as I've been stating, we are in a near-term downtrend, a downtrend simply defined as any security making lower lows and lower highs. So from the point where we shorted it, it is a downtrend. We're on the right side of this trade. If we start to go up, we start to take out all these previous reaction highs, it's not so black and white, guys, but you know my thoughts. I've shared them pretty clearly. When I go to the daily chart, we had a symmetrical triangle pattern, which we broke down from, right? As somebody pointed out, and I covered yet last week, there could be, it's a little bit big in my opinion, but it could be a bull flag continuation pattern. And again, you have the positive divergence on the 60, and you still have the PPO in bullish territory. By a hair, it's pointing down, but remember, these are my trend delineation lines down here. That's typically delineates a bullish trend when you're above. And these lines act as support right there. You bounced off the yellow line, you bounced off the yellow line. So we're just at a critical technical juncture. And I cannot impress that enough. And so where I was going a minute ago, if things go the way I think they do, and that these divergences do not play out for a move to new highs, or at least a significant double-digit rally, or 10, 8, 5, 8, 10% plus, then I think it'll be a very quick move down to my fourth and final target. That's still my current expectation. And so personally, I'll keep the core short, position on, and I'm not going to go crazy until at least I start to get some direction, maybe after Wednesday. And I'm talking about adding to that or subtracting. But as I'm going to go through in this video, that is one and should be. Again, you do you, I do me. If you're trading the indexes, whether it's small caps, S&P 500, Nasdaq 100, that should be one of at least several, if not a half dozen or more different uncorrelated trades. You know me, I'm big on diversification, asset allocation, and I truly feel bad. I don't share in your profits. I don't share in your losses. I feel bad when I hear somebody says they're 20% underwater on a trade, because especially if they're using a leverage ETF in a sideways trading range, like Bitcoin's been going around sideways for a while. The market has. It looks to me like everything's building energy, waiting to break out one way or the other. And that sooner or later that will happen, and that's going to determine the next tradable trend of the market, whether we get an upside or downside break. So still looking for that. We'll have a good idea, I think, by end of this week, Friday, and most certainly next week. Sometimes Fridays love to leave you guessing, just like they did this last Friday when we parked on the bottom of my first target zone. And then there's a good example. We broke down again. We reversed exactly where I expected a reaction. It's been a minor reaction so far, but that's why the market didn't crater, is because of the heavy economic calendar this week. Right? I think if this breakout occurred, on next week, let's just say where all those big earnings reports and the Fed were out of the way, I think it would have probably built on. But this is what you get during these kind of weeks, and that's why I take breakouts or breakdowns with a grain of salt. All right, let's move on. I do have, other than QQQ making a new low today, which again, one cannot argue on face value, that's nothing but bearish. Again, whether it proves to be a whipsaw or just a brief breakdown, it's hard to argue that a new low is anything but bearish. But we do have some other developments worth noting in the semis. Remember on the update I gave you today, the semis pretty much need to take out. You also have 60-minute charts with levels. This is 504.27. I've had this here for a while. The semis are also, as I've mentioned, in an unmistakable downtrend. I talked on this last week when there were some comments from one of the subscribers who's down on their SOXX trade, SOXX, the 3-time leverage, because it's kind of been a grind, a back and forth grind, but it's a downward grind. There's no mistaking that the near-term trend is bearish, but it's not that moment yet to use a leverage ETF. And honestly, again, although I cannot give individual investment advice, I would say this: if you have to ask, stay away from 3-time leverage ETFs. If you're a very experienced trader and you know when to use them, as I've talked about, if we get an all clear after the big 4 tech companies and the Fed are out of the way this week, that may be a time to switch from an SOXX short trade on the non-leveraged 1-time ETF to a 3-time, because if you look at my daily chart, I still have, I gotta zoom in, move them up. I still have some deeper price targets. Again, right now I'm just kind of really eyeing that T3, just like on the Nasdaq and the S&P. I'm just looking for a pullback to the 200s at this point in time, but very much open to more. And you can see the PPOs starting to cross below. Although it did it right there before. See, really, there's the delineation lines a little bit south of the 0 line here. Let me put it up. And again, I'm just looking at where we had that crossover last time. This is how I do it. So I'll look and see the most recent there. So I'll make that, I'll just color it up yellow. So we're right on the line right now. Again, it's I see so much in the charts right now, including these trading ranges. Now, the semis, again, are clearly in a downtrend. Um, and I think they're going lower. I'm going to rifle through a few real quick just to show you what's happened today because I had a few price alerts trigger. Um, Lamb Research broke that trend line and the 304.84 support. All these were covered in recent videos. That was the next sell signal I was waiting. So now we have a checkbox on one of the, let me sort them by market cap here real quick. Let me go through here. NVIDIA still above my purple support zone with the confluence of price in the 200s. So we need that to go. Taiwan Semi continues to dance on this first price target support 385.29, but almost tested it again today, waiting for a break of that level to open the door to drop to T2 and the 200-day moving averages right there. Broadcom still in a trading range. Purple levels denote the support levels I want to see go. Micron holding above support, but still, again, on sell signals. All these guys, we're short the semis because they're on sell signals. We're just waiting for the next levels to break, and I suspect they will. In the 490, 464.94, we'll call that 465 on AMD needs to go. ASML, nice breakdown today. So the reason I wanted to do this, guys, is just to tell you I've gotten a couple extra check marks. I had some price alerts go off early today. Remember on ASML, I've been waiting for that 1731.50 plus intersecting uptrend line plus 50-day exponential moving average to go. All three in one fell swoop today taken out. That is another. It just adds to another. It's just another breakdown of the next support. Remember, we first broke down and back tested this bearish rising wedge there, went sideways, held that support, and a clear and unmistakable breakdown right now. Intel, a beautiful one right here. The call on this one couldn't have been any better. We were in the trading range. Predicted the upside breakout would fail. Told you that additional, other than a fall back down into the range, a break of the uptrend line, which is also a bearish rising wedge, would trigger sell signal, which would likely send Intel back to the bottom of and then ultimately below the trading range. That's the purple box. We are clearly below it. We punched below it. They tried to recover it, but old Mr. 50-day EMA checked them. That's the yellow line right there. Got checked on a back test of the 50 and moving lower. So again, I see nothing but additional check marks. Applied Materials, I'm still waiting for this purple trend line to get taken out. Lamb Research broke down today, so there's another check mark right there. I could go on and on. As I go down this list, the weighting or their market cap gets smaller. Texas Instruments, look at that beautiful level. It's been dancing on 274.89 like a world champ. So just waiting for that to break. All right, you get the message. So the semis still look bearish, and I have more evidence today with more of them breaking down, and I don't think I see a single one recovering, moving back above a level that it recently broke down. That would be more bullish. If I go through and half of them have recovered trend lines they just broke or key support levels, but I see nothing but additional check marks in this sector. I just wanted to share that with you guys. And again, remember their fate, the semis' fate, is completely intertwined with that whole AI circle jerk trade, because obviously more capex spending from the big mega tech companies means more demand for semiconductor chips. So both the chips themselves, the chip makers, and the chip equipment makers like Applied Materials and KLA C10 Core, that benefits them. All right, enough on that. And remember, this is a sector that I'm all over this like white on rice, because I think there's a generational short hop here potential, just like there was in silver. If you caught that, we caught the biggest drop in half a century, and there aren't many of those that go around. This may not play out, but if it does, I will quite likely add additional targets in addition to these, current targets on the daily chart. We'll turn our sights to the weekly chart if and when I think that there's enough evidence that it's over. We just have too many stocks right now, including the markets, the major indexes above their 200-day moving averages. So you just can't get too bullish. I'm sorry, too bearish on even a sector like this until you start to see this sector, the majority of its stocks, the tech-heavy Nasdaq, and even the S&P 500 start to take out key support levels, longer-term uptrend lines, their 200-day moving averages, and things like that. Okay, next up, the financials. The one thing, in my opinion, not the only thing, but the one thing that's held the market up. Again, predicted and we've traded this entire year. My theme has been sector rotation, individual stock picking. And so while you've seen this recent correction in the semis and in the Mag 8, first the Mag 8 started to correct, then the semis followed. But this is what's boosted the broad markets. Remember, you don't have, this is one sector lacking in the NASDAQ 100, but it's also the second largest of 11 sectors in the S&P. And again, if you trade the VIX, you got to wait for the financials and tech to both break. You can have the financials break and go down, and if tech's going up, the S&P is going to hold up because tech is the largest sector at twice the weighting of the financials, roughly. So financials, divergent high, big correction there. Same setup, divergent high as I gave you last week. We had a sell signal breakdown, a little kickback rally, which is perfectly normal. If it wants to go a little higher, it could come in and back test the uptrend line, the wedge that it just broke. But either way, you have long-standing negative divergence. It's a breakout that I suspect will fail anywhere from where we're at today up to here based on the current technical posture. But unless it does, then this kind of the what I call lights out level. You have an uptrend line off the lows that comes in perfectly with the 200-day moving averages. So there's a little bit of work to be done. You can see the 200-day, the red and blue lines right here where my crosshairs are. That's where that trend line comes in to kind of measure it out for you from where we're at today. Things can change. I'm going to grab a little high above the prices, but that's about a 6.5% drop just to get there. So we're going to need to drop a good 8% or so in the financials to take that out. If that happens, and tech and the semis continue to fall, the VIX should rock. And again, maybe this week has a chance to make or break that. So let's look at the VIX. So trading the VIX is like trading those leveraged three-time leveraged, whether it's inverse or non-inverse, especially in the volatile sectors. The ones that come to mind are obviously SOXX. XOSX. S is in Sam, the short one, or SOXL, the three-time long semi. You can lump in the MSTZ, that's the two-time inverse strategy. I'll try to get to strategy at the end of this video. But here's the VIX just really setting up, and that's why I am, if you will, overriding my typical bullish bias when I see a positive divergence on the 60-minute charts of the indexes like QQQ, like I started the video, based on everything else I've covered recently. The VIX looks like she just wants to break loose from the gates, get out, open the barn doors and let this stallion run. I guess I need to call it if it's a stallion. And these are all potential targets. And remember, this can happen very fast. By the way, this can happen very fast if, remember, Warsh, say what you want about him. I know I've heard the media, he's his own man, independent. I, and everybody listening to my voice knows that behind closed doors, Trump was only going to appoint somebody that he believes will be his puppet, and if he doesn't, he'll fire him. That's Trump's thing, right? So either way, now with overwhelming evidence, that supports a rate cut or a rate hike, or not doing a cut We'll see. I'll be honest with you. I don't know which way things are going to go. I gave you the odds, right now, of cuts, hikes, all that stuff. Let's just see what the Fed does and says. All right. All I can tell you is if either happen to get a hike, oh my God, yeah, forget it. The financials gonna go down. Tech will go down most likely. I'd be shocked if they didn't. The VIX could explode, or if maybe just they further take the odds of any cuts off the table. Again, we can go status quo and we can remain in this trading range for a while. And so the rest of this video, I'm going to show you the other things out there. Just get ready to move fast if we do get the downside breakouts in the financials and the next support levels in the semis and QQQ, because the VIX, by nature, when she wakes up and wants to run, she runs fast and hard. And if you ask me right here, oh, is it too late to buy, VIX futures or VIX ETN? I'm going to tell you, look, I can't tell you what to do, but I can tell you I wouldn't chase it there. So I've already got a little small position, very, very small position in the VIX futures, because I want to have that going into, because I think the risk reward is skewed to the downside. And I think things can happen very fast on Wednesday or Thursday. And it's a position I can either add to or subtract to, depending on which way things go. And it's a position not big enough to hurt me. Plus, the RR on the VIX, guys, by the way, this is a pretty big percentage move. But look where we're at. I like buying the VIX when it's at the low end of its trading range or support. That's when you want to go long, not just for the sake of doing that, because it can sit there long. When it's set up with positive, aka bullish divergence, like you have, because the downside's minimal. The VIX. Now, if you're using those VIX ETNs, especially the leverage ones, you're going to lose money because they have decay over time. Even if the VIX stayed and traded at in the same range for a year, you're going to lose money. If you don't believe me, just plug in any of them, VIXY. You'll see over time you're just going to lose money in those things because of the rolling futures. But if the VIX pops, I haven't updated this chart in a while, but there's the setup. We had a divergent low. I give you a couple targets there. We fell just shy of that one. And now we have the same divergence or even larger. But I don't track this often or chart it because of that, again, that decay. What I mean by that, just one more time. This is what it looks like over the last, here's a chart. If you bought it in 2012, you lost all your money, 100%. You're down. If you bought it, even going back, I'll go to a daily chart right here in 2020, you're still down 99%. But yet the VIX over that period of time is not down that much. If I go back here to the peak where it was from today, it's only down 58% from that peak. And so throughout that time, it's been up and even above that peak on several occasions. And if you don't know what I'm talking about here, this is the spot VIX. You and I, nobody in the world can buy it. Doesn't matter how much money you have. Elon Musk cannot buy the VIX with all his money. The VIX is a spot index. It's a theoretical index with a calculation methodology you can read about. All you can do, or anyone, is to buy derivatives that track the VIX. Those derivatives are the VIX futures. And you can go the near month, the forward, the next month out. You can buy options on those futures, or you can buy any of the various ETFs, whether they're leverage or non-leverage. You've probably heard me say this before. There's no reason to buy a leverage VIX ETF. The VIX has so much juice in it, even the spot VIX. When it runs, we've had several trades in it, even using those ETFs before, or the spot VIX, that have been triple-digit gains in short order. I always use the analogy, it's like buying a Porsche 911 Turbo, brand new from the dealership under warranty, but then taking it up the street to your mechanic and telling him to put nitrous oxide on it. Doesn't need it. The car's faster than you can drive in any city environment or even a rural street. So the VIX is just, I don't even know why they make leverage VIX ETFs. They're, I guess, for day traders. Okay, so that's all the volatile fun stuff. Let's talk about the boring stuff, consumer staples. As you guys know, I've been overall uh, bullish, but very selective on the stocks within the consumer staples area, mainly preferring there's other subsectors of it, but a lot of the ones I've been doing are the steady Eddie boring packaged food companies. I'm going to go over those real quick because um, again, my goal on this site, I provide analysis, I provide trade ideas, but I would be the happiest man in the world if everybody came back and said, "Hey, I've had a great year. I beat the market." I know that's not going to happen. It's, there's just people who are going to do what they want. They're going to hear about the potential in the VIX that I just talked about, or the semis, and they're going to load up there, and that's all they want to do. They want that quick, 30, 40, 50% plus trade. But sometimes it's these steady eddies that, win the race. And the other thing about this site is, I promise you this, unlike the three most important rules for running a website: content, 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 right? Just like real estate's location, location, location. I will never post trade ideas for the sake of just giving you a lot of trade ideas. I told you a couple weeks ago after the 4th of July holidays, I was going to get back in, hunt for trade ideas. It's been by design that I haven't given you a lot of new ones. My degree of confidence right now in both the market and the trade ideas I'm finding. I've shared some with you, and we've had some, don't get me wrong, but I'm still keeping the new ones light. And then I just wanted to update this sector. As I told you, a lot of these, I'm going to rifle through the ones that I share with you and tell you that although many of them hit their final target, like KHC, remember these were first highlighted back, I think it was April. I'll get to that in 1 second. One of the charts, I started highlighting these back about right here. And then I gave you, in the video, I told you which ones I liked. I screenshotted a handful, gave you actual targets, made them official, but they've all been trade ideas. And KHC was one of the official ones. That means you had specific price targets, stop losses, and all that other stuff. And it still looks good. In fact, these are longer term targets. Now, I did harvest it on final targets. That's usually my trading plan. It's going to be to take, if I'm still in one of the ones that I gave you, I'm going to book profits, which I did, but I've also recycled back into some of these. And I still think this sector has potential longer term. Why? If you turn off all the lines, forget about my targets. This stock had been in a bear market. Number one, I'm just seeing money rotation, sector rotation into here. As I predicted we would see from the pros on Wall Street, the institutions. The tech stocks, you may believe, and you may be right, that this AI thing is only in its infancy, has a lot more room to run, and the chip stocks have a lot more room to go. That would be your opinion, and you may be correct. What we know factually is the valuations on a lot of these companies, the majority of them, are insane. So from a pure valuation perspective, professionals on Wall Street that manage money can't load their portfolios with bets on extremely overvalued stock. I mean, if they run a tech fund, a semiconductor ETF, or a tech heavy fund, an aggressive fund, sure. But I'm talking generically, I'm talking, pension funds, things like that. CalPERS can't just load up on the AI bubble and bet that it's, in its infancy and then blow the whole thing up. And then you're going to have teachers and firefighters and policemen that aren't going to have a pension, or they're going to have to, tax Californians more than they already do to make up those shortfalls, because that's who's on the hook for it. If CalPERS, who's already underfunded, as we all know, most public pension funds are. Anywho, my point is, guys, they rotate into where value is, and these are these charts of these are stocks have just recently broken out. They're just come off the divergent lows, and so my point is, a lot of these you can use the same levels to buy pullbacks through. For example, let's just say KHC, which already hit our final target, comes back in, pulls back, has a correction because the market goes down. Well, the 200-day moving averages, which act as resistance in a bear market, once taken out, you flip the trend is then bullish. You buy pullbacks to the 200-day moving average. It was in a big sloppy range there, so no, I don't have a good example on this particular stock. But These are all, you can see some lines here that I have where this stock could be headed longer term. I'm going to rifle through the rest of them. And again, maybe we sheared off all the meat on the bone. I doubt it. This one's still setting up. This is GIS, General Mills. Again, highlighted back here. Went a little lower, broke out of the bullish falling wedge. Recently hit my first target. I still have two additional targets. You have the 200-day moving averages coming in now. Remember, when I first laid out these targets, there's no way to know if and when the stock's going to get to the 200s. But I just want to point out, just like you got rejected there, here, 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 ever since you lost them, that is going to be resistance. But if we break these out, especially if the market holds up for another, let's say, 6 months to a year with more of this sector rotation that we've seen, it is, again, you cannot argue. Some things I talk about are subjective, my opinion. One thing in the beginning of the year, it was my opinion that it would be a stock picker's market with sector rotation and individual stock picking outperforming the indexes. That is no longer debatable. It's been well documented, and we've seen it here personally with our trade ideas. Now, the point on that is, going forward, will it be or not? If there is a broad-based sell-off, and big drop in the market, 20 to 40, 50%, or some of my, I still have those long-term targets of about ultimately a 50% pullback drop or more in the NASDAQ 100. If you get a broad-based sell-off, that's going to put pressure on just about everything. But unfortunately, because they're components, even if their earnings are holding up, and again, these are defensive issues. So what that means by nature is, when things in the economy turn south, or the stock market, they tend to outperform. Outperform doesn't always mean go up. It just means go down less or go up if the stock market's falling. Because again, you don't stop buying your Cheerios in a recession. You got to eat breakfast. And if that's your cereal, you're going to keep buying that. But you may cut your Netflix subscription out. All right. So you guys, so either way, my point is, on a lot of these, these pullbacks, still longer term, they still appear to have, a lot of them have a lot of meat left on the bone. Again, many of these, like HRL, we hit my third final target. You had a downtrend line, but now look, we've had some consolidation. Again, this was a bullish falling wedge breakout. If it breaks this trend line, we're already above. Here's a great example, guys. Look at this. You took out this stock's been in a bear market, getting smacked down, lost the 200s right here. Clearly lost them. Rejected, 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 rejected. Tried to break out, but couldn't hold it, failed. Rejected, rejected, rejected. Another failed breakout attempt. Rejected, briefly rejected, and then boom, breakout. And then something different's been happening by pullbacks to these 200s, right? So this one, again, we've sheared off the meat of the initial run, but if we take out, we're now above the 200s, and whether we break out and run up to this next potential target or we pull back, as long as they hold above right here, because you've got the 200s, and that was my second price target before. If you fall this way down, you've now lost the 200s. That's not going to be good. I would not add. That's the no-go zone. So this is the buyback. Any objective pullbacks to this level, and you may not get that. If that's all you're waiting for, they may break out and continue to run. There's been, like I said, I'm watching this sector. I like what I see. Here's one, SJM. Again, I covered it right here. That was when I first highlighted all these guys that I'm covering now, the ones that I had flagged. April 16th, right there. And we just hit I gave you two targets on it, maybe three, the downtrend line and the 200s. And look what happened to this stock when it took them out. It hit them, it was consolidating, was reacting on the trend lines and the 200s, and then it exploded higher. And we hit my final target. It would have been, I believe, let's see, when did I create that trend line? 522. Oh yeah, back in the year 2022. And so that was the target I gave you, the final target in the video. and 28% plus. Remember, you get paid to wait in these guys. 3.8. That 3.8 dividend yield would have been higher back below here because dividend yields are calculated on the dividend based on the price. It was probably north of 4% when we first bought it here, and so you would have collected that too. Now, where are we at now? Again, what I'm doing, I'm not big on hindsight analysis unless there's a takeaway. The takeaway is this has been a, this is resistance. If we can pop that level, now there's some negative divergence. If anything, right now, put a gun to my head, I have to short the stock. Why? Because you're at resistance, which is also my final target, with negative divergence. But if the stock can either power through that divergence or maybe it pulls back, comes back into this trend line, comes back to test the 200s. Again, it's pretty simple. You can buy back down to, but not below the 200s. All right, let's move a little faster. DAR, again, nice run up since highlighted, but negative divergence right here. CAG, this one's still plenty of meat left on the bone. It's still an official trade on the site with 1, 2, 3, 4 total targets. It needs to take out. I added these 2 resistance levels recently for you. You got the 200-day moving averages that come in right now with T1. If it can pop that, you see, there's all the targets. And again, a lot of still a nice looking chart I wanted to point out. And if this is correct, it's paying almost a 10% dividend yield. I don't know. You'll have to verify that. Use go to the company's website and verify the dividend or Yahoo. LW, another one of my favorites that I highlighted. Again, April 16th, somewhere in here. The stock's already rallied about 30%, 26 plus the dividends again, and has just taken out. Look at this, it's powered through. You have a little reaction here, so I'm going to tell you, if you want to play it safe, what did I just do? I came in because this is where I had the resistance level at 50.75 based on the bottom of that gap. But there is a reaction there where it tried to enter the gap and fail, and we're there now. However, it's taken out its 50s. It's taken out this resistance level. And if it can power through there, there's really, there are some other resistance levels along the way. I'm going to give them to you right now in case you're in this one. I see one right there, but there's the top of the gap right here. So now, if we can just pop that one, we're going to clearly be into the gap. And the problem here, that was a bear market rally below its 200s. We've now taken back the 200s, increases the odds of that gap backfill. And that would give this stock another 13% plus whatever dividend they're paying. PPC, still like that one. Breakout, back test, secondary trendline breakout. It's consolidating right here. Really, this is a level it needs to pop. If it pops 30.32, should run up to my 30.10 target, which is going to come up with the 200-day moving averages, which is approximately 16.5% above current levels. And then you have a longer-term downtrend line, some additional targets up there. CPB, active trade. T1's already been hit. T2 comes in with the intersecting price, about 25.60. The 200-day moving averages and the downtrend line. That would have been here. That's what that is. T2 equals first of the primary downtrend line. You can see I created that back on April 15th. T2 is the first of the primary downtrend line and or the 259, 25, 59-ish resistance with any overshoot into the 200s just above, also potential price targets. So there's your target, next target zone, guys. 7, if this is correct, 7.29% dividend yield as well. So although it's taken a little longer than some of the others to play out, we're getting paid to wait in that one. Not to mention it's positive in price also from our entry. BR, that wasn't one of my favorites, but it looks good now. If it can break this trend line, here's, just a lot of these, they're going to get probably called back to their 200s unless the market craps out, takes the sector down. JJSF took, this is the trend line it needs to take out right now. This is my, what I call BOD, or benefit of the doubt trend line. 200 days price. This is if it can take out the 200s, this is an initial target. I'm going to give you one more target right now, right there, and maybe even a second. Okay, Mama, that one has too much divergence. I don't like it. Elway, I don't too much. This one, these are already high. These are a couple that I listed, not that I wouldn't, I wouldn't short them, but they're not my favorite that has negative divergence. And then there were some low price ones, USNA. Actually, this isn't the low price one. I'll get to those in a second. Bullish falling wedge, breakout back test, tested the 200s, took them out. Now, but what happened? Took out the 200s, but it's run into my 29.58 target slash resistance. Again, nice gain so far on it, about 32% from give or take from where we highlighted it back here in early April. Once it can pop this line and this line, it should come in and test its downtrend line. If it takes that out, that's longer term bullish. BGS waiting to break objective long entry on a break above this near term downtrend line. You still have some pretty aggressive targets. BYND, we quickly hit that one for an 81% profit in like 2 or 3 days. Setting up, it's a low price penny stock, very aggressive, but still nice looking setup if it can pop and run. Like last time I told you, I think it needs to break this 82 level. So it never hit our final target, and we bought it here, so it's still within a reasonable RR. So I've left it on as an active trade, just waiting for it to break out those next resistance levels. LFVN, highlighted that as one of my favorites on April 16th, right here where this arrow was. And we hit that one, my final target, for a 145% profit in just a matter of a couple months there. Pulled back down, and it's been consolidating. It's testing right now. Look at this. It's testing its 200 simple, the blue line. So if it can hold that and get back above the 200 exponential as well, then that one should run and could make another run at that same 1139 target we already hit. Hain, this one just keeps walking lower, needs to break this trend line. Also a low price penny stock, so use a small if you're going to take it. Pass if it's not your cup of tea, but if it can pop that trend line, profit potential on this is as much as, if assuming that it breaks out, T1 would be a 90, about 100% profit. T2 would be about 175, and T3 would be about 329% profit. And then finally, RKDA, same thing. You need to pop this trend line, a low priced penny stock with a lot of upside potential if it can pop the downtrend line. Okay, also like the grains very much. I've shared with you, you can use, if you want a one size fits all, till combines equal weights of wheat, corn, sugar, and soybeans, all of which I am longer term bullish on and have been for a while. We keep hitting this 19-ish level right here. We had a divergent high the last time we hit it, sent us back down here, ran back up. So this is just a kind of a trading range, basic pattern. Right now, we might get a little more downside on them on the sector. I'm going to go through the components, but you have a little uptrend line that was recently cracked here. So it could keep this one in its trading range for a while. I remain longer term bullish, but near term kind of This is wheat right here, one of the components. We pretty much roughly have about equal highs on the indicators and slightly higher high there. I'm still longer term bullish, and look, this one has turned the corner. Remember, on the spot wheat chart, it looks better than this. This is an ETN. I'm just going over the ETNs now because I'm on this charting platform for easy reference. But that was a failed break above the 200s. There was 2 rejections, 3 rejections, but we clearly took them out here, back tests, and we're above it. So you guys know I have very aggressive long-term targets. I believe that the grains are an early stage bull market action, so I'm still a proponent of buying pullbacks to support any of these, but where I wouldn't add to if we drop now below 2168, that's no bueno. We already put in a divergent low, broke out, took out the 200s, back tested them. The 200s are right there, so anything down to here would be an objective re-entry add-on. And then sometimes with wheat, you just don't get that. It can burn through these divergences. It wouldn't surprise me to see it do that. Corn tends to trade very similar to wheat. Just broke a near-term uptrend line after put in a divergent low, moving up. Again, the long-term charts remain constructive. We hit my first targets back here. When you look at the spot price of corn or corn futures, it looks better than this. These ETNs, again, they do their best to track, but they're rolling futures. They have additional expenses and fees that they have to incur for that reason. So, what's the other one? Soybeans, SOYB, and then sugar. Soybeans. Oh, nope, that's not it. SOYB, soybean ETF. Put in a divergent low here, hit my first target again, finally took it out. That opens the door to the next targets. We hit T2 and 3, pulled back. I highlighted it here for you at the time on a pullback to this uptrend line as an objective long entry. I believe I highlighted it here and here and here. Went up. What happened? T3 was already hit. Opened the door for the next run at it. We went right through it, hit T4, pulled back to T3. Would have given you an objective re-entry point or add-on right there. Here's an example. We put in a divergent high. It gave us another correction back to T3, but we're above, we're above the 200. See how this stock was getting rejected? It was in a bear trend below the 200s, rejected. It's kind of flirting through them. It took them back here. That's where it took back the 200. Successful back test, big rally, and we're still above the 200s. Now, steep negative divergence. We just hit my fifth target last week. I need to do an update for you on the site, but I'll just do it now. And we hit it there. It was and still is resistance. We overshot it by a hair. Remember, as time goes on, these lines are going to drift a little from the actual spot futures, spot price of soybeans. But so again, near term, little hot, negative divergence. We could get a pullback all the way back to the 200s or not. But if we do, it's an objective re-entry at any of these levels. You have a gap right here. That's support. You have these previous highs. These are all support levels here. So there's your buyback entry, re-entry zone if you took some profits there. Down two, but of course not below the trend line. I'd prefer to see soybeans stay above T3. I really would. So I wouldn't add. If it goes below there, you can sit tight if you're a long-term investor. If it goes below the trend line, something else is happening. So right now we're so far above it, it's not even worth mentioning. I just wanted to say that at this point in time, they look a little soft. Might look at risk for maybe a little more pullback. But again, I've traded these guys where I've seen these like bearish setups, divergences and whatnot, and they get burned through. So it's not an all out. I'm keeping a core position of these. I just kind of micromanage that position based on the charts. And, when I'll get to price targets with divergences or trendline breaks, I'll take some off the table and then I'll add that back on pullbacks, like I mentioned, strategically. All right. And then I think I covered cane, didn't I? No, I didn't. Cane is the sugar ETN. Probably give you another trend line right now that needs to be taken out. That's part of till. I don't know why they put sugar in with the other three, but either way, they do. And it still looks good. Looks like it's bottoming here. Just needs to bust out of that trading range in the downtrend line. All right, treasuries. I'm not going to spend a lot of time. You guys know my thoughts. I've been covering treasuries like white on rice lately. This is TLT. This is a busy board. Let's turn off all the lines. As I've stated many times recently, these lows in TLT. TLT is the ETF that attempts to track the 30-year, the long bond. TYX is the rate. So as I've covered many times, any breakout, which we've had little pops through, are not just 52-week or multi-year highs. These are your year breaks, 2024, 2025, 2026. This takes us back to exactly where rates were just before the financial crisis in 2007, as well as where rates were just before the dot-com bubble burst in March of 2000. So in other words, and it's still my expectation, whether it happens now or within the next year or two, that we are going to break out, that I do believe and made the case repeatedly, we're in a new secular bull market in rates, higher rates. And whether we pull back first or not, I expect a breakout. Now, if we break out this week, next week, then that I see as nothing. I cannot come up with a a scenario in any way, shape, or form that's bullish for equities or wouldn't be bearish for equities. Let me be more clear. Especially a solid and sustained breakout. And again, guys, it's incremental. It's not binary. We popped it a couple times, but the Treasury Department's coming in with everything they have. I promise you, this is priority one at Treasury right now. Control the long end of the curve. Fed's going to do what they can do on the short end of the curve. That's what the Fed manages. I mean, they can get in and buy bonds too and do all that stuff. But as far as issuances go and whatever other shenanigans and tools they have, we're already seeing it. I've covered it quite a bit lately. UK gilts, Bank of Japan, sovereign debt, long bonds, all breaking out, starting to punch through and test multi-year and even multi-decade highs. And again, it's economics 101. There's no textbook out there or credited academic that's going to tell you that rising interest rates are anything but net bearish for the stock market and the economy. But it doesn't matter in the short term because you got this AI bubble, right? As long as the big tech companies have a ton of cash and they have a ton of cash flow coming in. And so there's this very unusual situation where they're keeping the equity indexes at multi-year highs, while the rest of the stock market, like the bottom plays that we're doing, we're buying stocks that are in bear markets. You're not going to argue KHC. We've done very well on this one and a lot of those other food stocks, but it's down 54% in the last couple of years, and so that's the story of the stock market. Over half the stocks are below their 200-day moving averages. Many stocks are in their own little bear market. If you took the gains from tech and everything related to the AI bubble out, we'd be one of the worst bear markets in decades right now. So it's a very, very unusual times. And that's why we're trading it, tactically, strategically. We're positioning longs where we need to be long, short where we need to be short or about to be. All right, let's move on. So watch Treasury yields. The 10-year bond I know is probably more important. The 30-year is very important. Don't get me wrong. But the 10-year also, TNX is the yield for the 10-year bond. Let me turn on all my lines. You have divergences. They could send it back down for another correction, but remember, these divergences can get burned through. So the markets are going to be looking for that previous high back in late 2024, early 2025. And then this right here, that was the multi-year, multi-decade high in the 10-year. And if the 10-year pops these levels, that's going to have a huge impact as well, because the 30-year mortgages are more closely tied to the 10-year Treasury bond. So watch that one as well. All right. I want to talk on Bitcoin. I want to talk on yeah, I'll just do it quick. All right, guys. Remember, Bitcoin, just like the semis, not time right now, in my opinion, to use any leveraged instrument. Remember, the proxy for Bitcoin, first of all, I want to see it fail. I've fully acknowledged, and I'm watching this bullish breakout. My guess is it's going to fail. Unless it does, you're going to first need to take out the recent lows. All the better if and when these divergences are taken out. Otherwise, this is a bullish falling wedge. We broke out, so I've acknowledged that. But again, it's one that I suspect will fail. I'm not a completely rigid trader. I will recognize bullish and bearish chart patterns. I'll point them out to you guys. You guys can trade them. I usually take a bullish or bearish chart pattern, but every now and then I suspect it may fail. And so we still have an active short. Our proxy is a strategy, because I think that'll be the blow up. And I'm also noticing, if you look closely at strategy, how it's been trading recently compared to Bitcoin. IBIT is spot Bitcoin. Bitcoin's doing a little better. You can see it's up more off its lows. And remember, it's going to be, in my opinion, the whole case of this short trade, the tail wagging the dog, right? So if strategy, because they hold so much Bitcoin, they use a leverage model and all this financial engineering, especially with their preferred shares, you can see how it is underperforming. And so You might have a lot of folks wanting to buy Bitcoin, and they are buying Bitcoin on the breakout now, and even strategy is broken out. But if strategy goes down, it's going to most likely take Bitcoin down with it. And again, so you want to see the divergences get burned out. That means the PPO goes down, takes out these previous lows. If you no longer have divergence and this breakout fails, it's going to sharply increase the odds you hit my next targets. And my final target, pretty much if hit, calls for a pretty a near wipeout of Bitcoin. Not It's not going to go to zero, but strategy itself, which is our proxy, will have fallen off its highs, 98%. So that's pretty much a wipeout. And again, guys, these targets, I know they're aggressive, they may or may not be hit, but it's based on a vicious cycle of selling, that if and as Bitcoin falls, strategy has to sell more Bitcoin. As strategy sells Bitcoin, again, that's a vicious cycle, and in a cycle which will not go orderly. At some point down here, if I'm right, and we get down to or below T3, T2, especially T3, will probably be in that full-blown liquidation vicious cycle mode, and it should be a quick crash type scenario, if I'm right. And if I'm not, and you're bullish on Bitcoin or crypto, there's a 110% bullish case to be made based on the recent trendline breakout, the positive divergences, the excessive bearishness. I was talking this thesis and giving you these targets long before the media was. The biggest, I should say, the biggest reservation I have on this trade is the fact that everybody else is kind of getting on that bandwagon and saying a strategy can have problems, or preferred shares are currently priced at 75 cents on the dollar. They should be trading at par, blah, blah, blah. But a trade's a trade. I don't see any reason right now to change our trading plan. We're profitable on it. We've already hit our first target, so that's that. And I'll continue to provide updates. Okay, long video. Let me wrap it up here. Again, you'll have the summary, so you can just click through. I'll try to make sure I get those hyperlinks working. I noticed in some of the summaries I've been generating, the hyperlinks were not working, where you can click on the timestamp. And that's it. Let me get this one out to you. Just sit tight this week. Be patient. There's nothing wrong with positioning in advance. If you think one thing is going to go one way or the other, be it Bitcoin, be it QQQ, the semis, the financials, the VIX, me personally, keep it light until we'll start to hopefully get some clarity and visibility on Thursday and or Friday. I say that because the Fed is a bunch of noise between 2 to 3 o'clock. May or may not. The initial reaction is usually not the one that sticks. Then you got the big earnings Wednesday night. So it's really going to be Thursday before the institutions have decided what they want to do with their positions after the first two report on Wednesday night. Then same thing on Thursday night, which of course Friday is going to be your first full regular session trading day there. So going to be a busy week, guys. You'll definitely get an end of week wrap up from me on Friday. And over the weekend, I may add, before trading opens for next week, I'll kind of watch things and let you know my thoughts and where the opportunities are. Okay, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.